Hey there, folks. Today, we're diving into a fascinating financial conundrum. Why are banks slashing deposit interest rates despite high inflation? It's a head-scratcher, right? Let's unravel this mystery together. So, imagine this. Inflation is soaring above 9%, yet banks are lowering the rates on our hard-earned savings. What gives? Well, according to the bankers themselves, it's a unique trifecta of factors. Strong deposit growth, an abundance of liquidity, and a surprising lack of demand for loans have made it less crucial for banks to lure in new deposits with higher interest rates. It's almost like they're saying, we don't need to work as hard to attract your money anymore. But there's more to this story. The central bank, Bangladesh Bank, has also stepped in with some policy changes. They've lowered the policy rate and placed limits on interest rate spreads, which has directly impacted the rates banks can offer. It's a complex dance between market forces and regulatory interventions. Now, here's where it gets really interesting. Syed Mahbubur Rahman, the managing director of Mutual Trust Bank, sheds some light on the situation. He points out that the yields on treasury bills and government bonds are lower than before, and combined with the excess liquidity and healthy deposit growth, banks just don't need to offer those juicy deposit rates anymore. It's a simple case of supply and demand, but with a twist. Mahbubur also mentions a crucial instruction from Bangladesh Bank: keep the interest rate spread within 4%. This has led banks to adjust both deposit and lending rates, but deposit rates are taking the first hit. It's a strategic move to maintain a balance in the market. Mohammad Ali, from Pubali Bank, adds another layer. He explains that while higher deposit rates have been a successful strategy in the past to attract savings, the game has changed. Leading commercial banks now have more liquidity than they know what to do with, and credit demand is weak. So, they're shifting their focus away from offering higher rates to depositors and instead are reducing those rates. An anonymous managing director from another commercial bank provides an intriguing perspective. He suggests that depositors are becoming more discerning, choosing financially stable banks over chasing the highest interest rates. It's a sign of a maturing market, where trust and credibility are valued alongside attractive rates. But here's the kicker: not all banks are in the same boat. Weaker banks still need to offer relatively high deposit rates to attract deposits and stay afloat. It's a delicate balancing act, and it highlights the diverse strategies banks employ. According to Bangladesh Bank's data, surplus liquidity in the banking sector has skyrocketed, reaching TK 327,877 crore in May, up from TK 235,500 crore in the same month the previous year. It's a clear indication of the excess liquidity that banks are dealing with. In my opinion, this situation raises some thought-provoking questions. How will this impact the average saver? Will we see a shift in banking habits as depositors seek better returns? And what does this mean for the overall health of the banking sector? It's a delicate dance, and I, for one, am intrigued to see how this plays out. So, there you have it, folks. A deep dive into the world of banking and interest rates. I hope this has sparked some curiosity and given you a fresh perspective. Until next time, keep exploring and stay financially savvy.